most recent year here at 500, supporting a lot of the global markets. So working with our teams and founders in Korea, Taiwan, Asia, working with the A16Z team. So with Andreessen Horowitz, working with their Talent Times Opportunity Fund on literally this topic. So the topic that I'm walking you guys through today is the topic that A16Z literally brings me in for our portfolio companies to help them close out their pre-seed rounds, their seed rounds, to craft their decks as it goes for demo day, for sharing with investors. So really that's going to be the topic of today. So the first thing that I kind of want to just set the stage for is just the plan for the day. I would love for you guys to ask awesome questions. Hopefully some of you brought your deck. The one caveat that I'll bring is if you're you have your pitch deck ready or a draft of it ready, and B, you're comfortable sharing it with the group. If you can just get like a share link ready, or if you're willing to just share your screen and kind of quickly flip through slides, but honestly getting a share link ready and dropping it in the chat is going to be way easier. About midway through, maybe a little bit earlier than midway through the presentation, I'll pop back over the Teams chat and we can pull up some of the decks. We probably won't have time for everyone depending on how many are shared, but just go through some like live edits, some live feedback so that I'm not just teaching you like the theory of it, that you're able to actually see how a VC is going to read into your deck specific to the early stage. And when I say early stage, basically like pre-seed, seed, and Series A is really kind of what the this pitch in particular and this pitch practice is kind of dialed in for. So yeah, like I said, if you can drop that in the chat in terms of the shareable link for your deck. But other than that, yeah, let's go ahead and dive in. And if you do have any questions throughout the course of the presentation too, like while I'm speaking, before we get to deck review, just interrupt me. I obviously can't see the Teams chat while I'm also presenting, so just go off mute, say something and just kind of interrupt, and I'm happy to kind of tackle the questions as they go. Does that make sense? Everyone good with that? Can I get some like proof of life, so thumbs up from someone? Okay, sweet.
Great.
Awesome. So yeah, let's go ahead and kick off. So I already gave you kind of my little intro, but let's dive into kind of the first part of the topic. So really what we're speaking about at the outset is the ingredients of a deck. So basically today can kind of be thought of as a workshop that kind of has two predominant components. The first side being like what goes into a deck, why it goes into it, common mistakes that I've seen reviewing and screening probably close to like 3,000 deals for 500 over the last few years, as well as all the mistakes that founders commonly make in the A16Z portfolio companies too. So I've seen some amazing decks. I've also seen, unfortunately, some really, really bad ones. And I want to give you kind of some bite-sized quick learnings today on what some of those takeaways look like. And then the back half, after we do some of the deck review, as long as we have time for it, is really around pitching. And when I say pitching, I literally mean like presenting that presentation, presenting your vision. If it's with a deck or without a deck, common use cases for this is typically like a demo day, right? So both with A16Z and with 500 Global, demo days are something that our founders go through when they're going through the accelerator programs. So often we work with founders for preparing them for that instance. A lot of those skills are also shared when you're pitching to investors in a closed door setting, right? It might be a little bit less of a formal or showmanship led pitch like it would be for a demo day, but a lot of those best practices are still going to carry over. So those are the two things we're going to focus on: the ingredients, structure, what should be in a deck, what are common mistakes as part one, and then part two really being the actual kind of public speaking presentation skills and how to kind of own that presentation and pitch itself. So at a very, very high level, there's kind of five core parts to a deck. And I'm not saying there's just 5 slides, there's kind of 5 parts. And this is the more important way to think about it, right? It's not just a slide count limitation. It's, where do strengths lie in your specific business? Every single deck needs to be able to cover these 5 things. Otherwise, it's going to end up in the trash. As far as statistics go, your average VC is spending no more than about a minute on your deck if you're emailing it out. And during demo day, typically you have 1 to 3 minutes on stage, right? So when you do look at slide count, it should definitely not be, a massive lecture of 50 slides. I've seen a lot of founders fall into that mistake, unfortunately, but it should be like 5 to 10 slides. This is just a teaser, right? When you're sharing your deck, whether it's in a demo day or when you're sharing your deck via email, this is a teaser deck. All it does, literally the purpose of it, is not to inform investors around making an investment decision. Actually, maybe I'll turn it to the group. Does anyone actually know what the purpose of a pitch deck is? Like, and I don't just mean for the sake of demo day, but in general, like, what's the purpose of a deck? Yes, same where I see you have your hand up.
Yes, hi everyone, or Sveike, right? I have really good ties with Lithuania. The purpose of the pitch deck is to create curiosity for them to book a meeting right away, so that they can invite you to the meeting, so that you can have it's like a resume instead of CV.
Yeah, 100%. The main thing that I want to double click on there is it's literally the sole point is just to book a meeting, right? It's that there's enough interest generated to book a meeting. Not they know everything about your product strategy, your IP strategy, every single member of your team, all of your sales to date, your full vision, your full founder story, your founder history. Like, no, it's not all of those things. It literally serves one purpose, that you're trying to put in and highlight the strengths of your business, the market, where you're competing, just enough information to kind of book that follow-up meeting. And these are the 5 things that through 500 and A16Z that we solely recommend honing in on. The one thing that you'll see actually isn't apparent here is market, right? As far as it being broken out as a subset. The reason that I haven't broken it out is because that should be part of your problem statement. The one other thing that I want to highlight here in this specific list is traction, right? So in the North American market, so I'm speaking about Canada and the US in particular, we typically recommend, especially when you're seed and up, to lead with your strengths, right? In your deck order. There isn't a fixed order. Um, and what that means is if you have solid traction, right, in terms of MRR, revenue, or any of those kind of solid quantitative metrics around your commercialization of your product, your software, whatever the case may be, lead with that early in the deck, right? That does go against the norms of a lot of decks that just lead with the problem and the solution. And a big portion of that, which we'll get into a little bit later, is on establishing trust. So really what I wanted to do with this slide is you guys understand just the actual framework and just the purpose of what a deck aims to serve. So let's start right off the top. This arguably should be the easiest slide for everyone, but the amount of times I see it done poorly, unfortunately, is very, very frequent. Your intro slide, the sole purpose of it is literally just conveying your one-liner, which is one sentence specific to your business that is not feature oriented, right? So it's not addressing what you've built or the technology or the IP, right? Its sole focus is what are you solving, right? It's not going into the details as to how. Essentially, from like a psychological principle standpoint, right? And this is another piece of data that has been gathered and proved and seen. And this isn't just specific to the VC space, especially in a demo day setting. There's about 3 seconds, right, where you have someone's attention. Before you say anything, right, they're giving you those 3 seconds to determine if they're going to continue listening and continue giving their attention or not. So starting with a powerful hook is going to be absolutely critical when you're presenting in public speaking. If this is a pitch deck that you're just emailing out, literally your logo and your one-liner is like more than sufficient for this page. You do not need to be putting photos of your product or other information at that outset. Like I said, this is a very, very easy basic slide. And all it's doing, when an investor opens this up or they see it in a demo day, they're going to read the solution-oriented one-liner, and is this a thesis fit or not, right? A thesis fit in terms of the sector that they're investing in, right? They're obviously not going to know what stage you're at and so on, and if that lines up with them being a growth stage investor or early stage and so on. But really having a succinct one-liner that is solution-oriented and that does not list out all your features is really what you want them to take away from this specific slide. And it should be very, very quick. The point that I want to make around that powerful hook and 3 seconds if I should care, right? This is
Simonas got cut off for me.
Mm.
and be like,
Yeah, we lost
hi,
them.
my
Simona, you got cut off for about 10 seconds. If you can back up, you just froze up.
Okay, can you guys hear me now? It's all good?
Yeah.
Okay,
Oh.
so the last point that I was making is the number one thing specific to opening a pitch deck, like in terms of the actual pitching skills, the presentation at, say a demo day, or in any kind of formal, kind of larger stage environment that literally every single accelerator is teaching and preaching in the US market, like between YC 500 and so on, is not starting with like getting up on stage and being like, hi, my name's Simon Grigenas, or like, hi, I'm the CEO of XYZ. That is a terrible, terrible way to burn those 3 seconds where you actually have everyone's attention in the audience. And a lot of founders actually sleep on this point. They think that those first few seconds being like, hey, can you hear me? Or is this mic on? Or like introducing yourself, that it adds any tangible value, which it really, really doesn't. So that's kind of what I wanted to hammer home on this point, that like what you should be focusing in on is a hook. And a hook, if you're not familiar with the concept, I definitely recommend, ChatGPT it, Google it, whatever you need in terms of like what is a hook as far as storytelling and storytelling narrative. But the short summary that I'll give you today is basically it is creating some kind of social or emotional tie to the listener. So when I first get on stage, say for example, I was developing a product, I don't know, in the healthcare segment, right? I pick up that mic during demo day, and it's focused obviously on my sector, on where my startup is building, right? And say we're building for, I don't know, just for the sake of an easy example, something around cancer prevention, right? Some kind of medication, treatment, et cetera, right? So we know that these patients and or clinics and or hospitals are going to be the outset. The patient, we know the problem in the sector that we're addressing in. So using a piece of, say emotional data to open up my pitch is where I would start, right? I wouldn't start with, hi, my name's Simon Grigenas. I'm the CEO of, I don't know, whatever, Cancer Cure Co., right? I would get up there and I would say, in the last 10 seconds of me walking up on this stage, 20,000 people died from this variant of cancer, right? Like you really want to generate a strong hook, right? Say you're marketing or ad tech focused, right? You could speak about how much money is wasted, right, on ad spend, right? So it doesn't have to be as extreme as obviously like deaths and health tech variants and so on. But you want to find a good hook that immediately captures, wow, like this problem is real, it's material. This is someone that I'm going to give my attention to hear out the rest of this pitch. So although this is such a basic slide, and a lot of you probably like your eyes glazed over when I pulled this up and it was literally intro one-liner, we already know what this is. Like I said, this is very, very important. When just an investor is spending 1 minute on your pitch deck, scrolling through it on their phone or on their laptop, but it's also very, very important in terms of in a demo day setting and in a pitch competition setting, if that's something you're preparing for. So I wanted to leave you with this 3 kind of main points to remember, and this is going to be the structures. Kind of we'll really break it down simply, so you kind of have 3 takeaways for each section of your pitch deck. So the next one that I want to speak about is traction. So traction, as I mentioned, especially in the US and Canada, is critical, right? We're wanting to see, especially with the advancement of AI tools, like you look at Cursor, you look at other AI enablement to be able to create fast-paced MVPs, especially if you're software. If you're a hardware product or a more traditional style business that isn't, a more typical kind of SaaS model or an AI model for commercialization, you're still going to have some of those challenges around customer acquisition, revenue, and so on. But in software, right, AI tools have really enabled the speed of MVP development and being able to get traction very quickly. So the investor expectation, at least in the fundraising climate that we've seen in the last like 6 to 12 months, both in the Bay Area, like I said, as well as in New York, is really that traction does stand, even at pre-seed. So gone are the days of like kind of pre-COVID, you're like fundraising on an idea, on a vision. You should have traction. And traction should also exist in the market where you're fundraising. A mistake that we see with founders constantly at 500 Global, especially ones that are domiciled outside of the US, is they think that they can come to the US and fundraise there to actually expand into this new market. it kind of makes sense from a founder standpoint, right? Like I need money to expand abroad. I've already proved my business model in Lithuania, for example, or in certain parts of Europe. Unfortunately, that's just not the case. We see so many international founders flying in to the Bay Area, to New York, trying to fundraise for a month, 2 months, and so on, and have a really really hard time doing it. And of course there's always going to be founders that are exceptions to these rules, especially at the growth stage if you're raising your series B or series C to expand into the US. But for the vast majority of founders, especially in the early stage, you should have US traction if you're planning on raising in the US. It doesn't necessarily need to be hard dollar revenue, but what is, if you're a pre-seed, can you generate a wait list? Can you do some unpaid pilots, right? If you're targeted towards businesses and B2B, right? How can you establish some credibility to the problem that you just opened with, right? That's what the point of traction is. It's that this de-risk and validation. And from an investor standpoint, like I said, some of these points might be obvious around traction and including it, but I want to share kind of the real-time centered focus of what's going on in the US and Canada right now for the fundraising landscape. And traction is one of the things that has greatly, greatly evolved, and the expectation for it, given the fact that the cost to commercializing a product and to building a product has come substantially down over the last 5 years. So moving on to kind of the three takeaways, three learnings that I want you to have for traction in particular. So number one, early for credibility. Basically, this goes back to the point that I was saying earlier, right? Move it up in your deck, right? Have it right at the front of your deck after obviously your intro one-liner or your problem solution, if you have strong traction, if you've validated your business. The reason that this is important is it kind of sets a flag post in the ground. Once again, speaking about psychological principles, right? The last slide, we were talking about this kind of 3 seconds that you have this attention of the audience or of an investor. For traction, why this is important is it basically communicates to me as the investor sitting and listening to you, how far along are you in solving this problem? Once again, is this literally a vision and an idea and it's not going to be a fit? Do you have a really impressive month over month or quarterly growth rate with strong revenue over the past year, right? It's going to immediately help me understand where do you fit in that spectrum that's very arbitrary of this like pre-seed, seed, series A, series B, and kind of so on, right? All the way up to, I guess, Databricks did their series J today, is the largest VC round ever in US history. So keep that in mind, right? Of trying to really promote traction as you have it, and follow, really importantly, this rule of three. So this is kind of a little tip and trick. I'm sure you guys would have seen it if you've ever kind of went through some public speaking classes or seen the McKinsey reports come out around this. But essentially the rule of three, and the reason we teach it at 500, is that the brain can only easily remember 3 facts, 3 numbers without forgetting one. As soon as you add in a fourth one or more, one of the ones in the list that were mentioned are randomly forgotten, right? So you really want to play off this principle and really focus in on what are the 3 main quantitative metrics that, like I said, it could be ARR or MRR, it could be just revenue year to date or month over month growth, it could be the number of paid pilots, whatever that number is, right? That best tells the story for your specific business. Really try to simplify that down and use those 3 main things. Because once again, the point of this deck, let's not forget the vision of where we started this whole workshop presentation, is that you are just trying to book a meeting. The slide is not to like show all your financial models, show every single metric that you have, show all of the users on your platform, right? Like it's just not going to work. Even if you have customer segments, right? It's just way too much data, and it's unnecessary to get the meeting or to perform well in a pitch competition. And that really ties into the third takeaway here, making sure that you're keeping all of these slides, this slide especially, simple. You do not need a very complicated deck full of a lot of text to get a meeting, right? Especially if you do a succinct job on communicating the problem that you're solving, your one-liner, the solution, and your traction. If there's interest and you are actually a thesis fit for that given investor, it's going to get booked in. And this is, if I had to kind of pick one thing on this list that is a really, really common mistake, it's usually overdoing it on slides. And we'll kind of speak about the red flags of common mistakes that founders make later. But the traction slide ends up usually being a notorious slide where there's just too much information, especially at the seed stage and onward. So I'm going to take a quick pause here because we went through intro, one-liner, traction, kind of covered quite a bit. Is there any question that anyone has related to those two specific slides? Obviously, like I said, we'll continue through the backstory and some of the common mistakes, but want to give you a chance to ask questions. If you have one, feel free to just unmute. You don't have to raise your hand or anything like that.
I raised my hand.
Oh, yeah.
Can
Yeah,
I?
go ahead.
Yeah. For example, you say to show traction, but if your product is not on the market yet, so an investor, what can you do? I mean, can you show some respectable researchers like McKinsey or Statista info, or you should show what's the need for your product or service in the market? I mean, how you can depict that in a
Yeah.
convincing way?
Yeah. So the short answer, which is probably the answer that you don't want to hear, is you still need some kind of traction. So whether that's like a customer wait list, right? Your product might not be live, but you do have the wait list. That's if it's consumer focused. You could do that in the case of enterprise sales and B2B as well. Do you have any LOIs with these enterprise customers? Obviously, like there's nuances to what type of business you have, but like the reality, especially in today at pre-seed, if you're at the point where you're fundraising, you need to demonstrate some kind of traction, whether that's around your beta, your users, your wait list, what your pipeline looks like for your sales pipeline. You're going to have a substantially more challenging time not having any traction down, period. And like I said, there's always going to be exceptions to this case. If you're like ex OpenAI and you've been building AI tools for like huge FANG organizations or teams, can you go and sell a vision and or a product idea with absolutely no traction? Probably. But for the 98% of other founders, there's going to be an expectation that there's something there. And not to say that the problem or the solution is invalid. It's just think about it from my shoes as a VC. I see probably 200 pre-seed decks a month that I'm flipping through, and you're going to compete against the other companies that do have traction or have, although they might not have revenue and they're pre-revenue, have gone through the efforts of trying to quantify some of that interest and get it papered, whether it's in the form of a wait list and so on. So I don't think necessarily it's a great telltale sign. Obviously, wait list conversion and so on is a challenge, but I do think there is an investor expectation of that in the North American market. Does that kind of answer your question, or was there any follow-up?
Yeah, thank you.
Yeah. Any other question on kind of the slides that we just spoke about here?
Simon, I have to add here that, I mean, this is perfect for, in many cases, unless you have a very good team, like ex-Google, ex-Amazon, ex-Uber, and they are like top-notch guys. They don't even need a pitch deck. They just, because of their network, they're so well connected. They come with an idea. They're like, hey, this is it. And because of their history, they don't have to prove anything, I think, in many cases, when they have either a good credibility, like you mentioned, or the history, and they have done it before. So many people left OpenAI right away and they just raised millions without even a single website. They just had a dummy thing, right?
So I'll add a caveat to that, because like we have invested in teams out of Google and OpenAI and MIT and Stanford, Harvard, kind of like all the buzzword names that you want to see. We reject founders from those FANGs all the time, all the time. They don't make the cut, even with a pitch deck, even with a business model, even with traction. So I wouldn't say it's guaranteed. And like, mind you, there's some distinctions, right? Like I do think, at least right now in this hot market over the last 12 months, if you're coming out of OpenAI, you're probably going to be more ranked than like somebody coming out of Google or Meta or whatever. But the reality is that you still need to be succinct in like how you're communicating this, how you're putting this across to investors. Yes, there is for sure though an exception to, if you've built and exited startups successfully, yes, you're going to have investors that have been on your cap table in the past that you already have trust and credibility with, that literally you can just give a call to, right? It's a little bit of a different circumstance and it does make it easier. But I do want everyone to kind of take away that like even with FANG backgrounds, you're still getting, cut and rejected at YC, at all the big names, because there's also a lot of those founders, especially in the Bay Area in New York, when you look at like the tier one US markets that we're just seeing day in, day out. And because some of them aren't putting in that effort because they think their like team background will get them over the line, once again, they're still needing to compete against the other deals that I'm seeing month over month. But yeah, you do bring up a great point, which is, trying to really leverage the strength of like domain expertise and the team background. So yeah, let's continue on here. The next piece I want to speak about, problem solution. So this should hopefully be readily clear to many of you that VCs are going to benchmark the problem that you're solving more than the solution, especially at early stage. And remember, when I started this presentation, I said that we were going to focus in on some of those early stage nuances, right? And the reason that this is going to be the case is because early stage founders pivot a bunch. Like in the companies that we invest in at 500, I'll just take the ones that we've invested in Canada through my team. I don't even know what business they're necessarily going to be building in 2 months. But what I do know and have confidence in is the team, their domain expertise, and the problem and or the market that they're chasing, right? So that's what's important to me, that the market and the scalability for solving in that market is available and apparent. And then I have confidence in the team, especially at a pre-seed stage, that they're going to be able to find some kind of solution to be able to solve something related to that problem. And it might not even be the same solution that I'm investing in as of today. It could be a totally different MVP. They could pivot completely. And I find that founders often make this mistake, right? They over-index on like the technology. If you have a pitch deck right now that's like you have 3 slides on what your product looks like, whether it's hardware, whether it's software, and you're going into like, these are the patents we hold, this is what we've created. You are unfortunately one of those founders that it's fallen into that trap and that mistake. And like, don't feel bad. I've literally done it. I've had my fair share of bad pitches and needing to learn these lessons the hard way, which is don't be solution oriented. Your job, especially if the audience, in terms of, it doesn't have to be a large scale audience, it could be like a one-on-one audience, that your listener, right, understands the market that you're chasing and the problem within that market that you're trying to address. That is more important, especially at early stage. Yes, at growth stage, when we're talking series B and up, there's going to be an assessment of the solutions that you have built your repeatable sales and scalability on. We're going to be benchmarking you in a different way. We're going to be measuring you against the competition and how your solution is differentiated. But like, don't take those growth stage principles and apply that to early stage. Unfortunately, especially in pre-seed and seed, it's just not a one-to-one. Right? The one exception of this, and this is not my domain of expertise. So if you're building in deep tech, by no means, do you need to take my advice here, because it's a little bit different in how you fundraise and how much capital you need to actually build out your initial solution. So slight nuances here for the deep tech space, but for the vast majority of these other sectors and founders building in these other spaces, really honing in on problem, trying to quantify that market is going to be the better approach, as opposed to focusing on the solution, right? So that is kind of my first part here around, problem focus, not features, right? Features change and evolve as you iterate and experiment with your engineering team, with the technical team, with how you're implementing that given MVP or that given product. And please don't come forward as an early stage founder and say you have product market fit, because product market fit is going to come at a growth stage. Sure, it might come early for like 0.1% of startups, but just don't be that founder that is going to immediately have an investor in the US, their eyes glaze over just because you succeeded in Lithuania or Asia or another external market, and you think you've figured it out, yet you're only sitting on $1 to $3 million in revenue, right? We see these mistakes often come up in these slides of like an being overly confident in the solution that you have as of today. It's going to evolve and change, and that's totally okay and to be expected. That is the norm when you look at the American market and the VC space. The second point that I want to speak about here is stories. Right? Stories do an amazing, amazing job of conveying exactly the problem, right? Telling a story about one of your enterprise customers, or say you're consumer facing, right? Speaking about one of those users and the journey that they went through, and kind of creating, maybe it's a little bit of like a humorous story around, this was their experience before using our app, or after, before a subscription or after, right? Like, going through this exercise, it obviously forces you to continue to focus on the customer and customer discovery, right? So the inherent, like, kind of psychological trick that you're using there as part of your pitch, whether it's for demo day or in an investor meeting, is that there's already an underlying assumption. You're giving examples of speaking with your customers. It's a positive. It's a green flag, not a red flag, right? But what it also helps do is then they don't just have to take, your word for, there's this huge problem in like the construction tech market. Vendors aren't able to source quotes fast enough, right? If you're actually able to speak about someone going through that challenge and pain, use their specific name, it's going to kind of kill two birds with one stone, right? It's going to both help them in terms of understanding your problem and how you're going about solving it. And it's once again re-emphasizing that you're building like customer discovery led, so customer led in that sense. So really, really recommend using stories when you're focused on the problem and solution part of your deck. And this is going to work great for you in like a demo day setting, in a pitch competition, as well as in those actual investor meetings themselves. The last thing that I really want you to take away is around your product. Like, how do you showcase your product, right? So, staying away from overly busy screenshots or videos that are going to take attention away from your deck as a whole. I've seen founders literally put in like a Loom demo video embedded into their deck. Please don't be one of those founders. Like I said, you only have about a minute if you're emailing out this deck to investors, that they're going to scroll through it. So given the fact that they're going to be quickly reading the information on those slides to make a decision to take the meeting with you or not, they're not going to sit down and watch this full demo, right? So really, really be mindful of their time and how long you have that attention. And in a pitch competition or a demo video, or a demo day, please make sure that you also have the attention of the audience on you, right? You want to use your body language, your tone of voice. You want to be the presence that everyone's paying attention to. You don't want to suddenly lose everyone's attention and turn their focus to watching a video, or like watching a bunch of like animations related to your product or your app and so on. So really, really kind of common error here when we look at like the problem solution split. And although I have it on one slide here, I'm not saying you need to combine it and overlap it all on one slide. I'm saying, in those two slides, say that you do have kind of this area of focus in your pitch deck order. Just make sure you're kind of following some of these rules that we talked about today. Did I hear someone unmute? Did someone have a question? Nope. Okay. The next one that I want to talk about is team, and we'll be a little bit quicker here just so that we can turn the focus to some of the deck reviews. So I just wanted to drop this as a quick reminder. If you have your deck, I see that there's one already here in the chat. Create like a shareable link for it. And if you can just drop it in the chat, then we'll just pull it up and we'll kind of work through them in order. And then we can kind of continue on. So yeah, team. Very, very important. It already came up right earlier in our chat, right, around founders that have this strong background from FANG, right, that they have an easier time fundraising. It's true. Domain expertise, it doesn't need to be within the big FANGs or OpenAI. Domain expertise does matter. Whether it's right or wrong, investors in today's climate do index on you having professional experience within the sector that you're trying to solve. So say you're building, like I said, in construction tech, right? That you've worked in that space, or if you're building in healthcare, right? And you've never been within that space professionally from like a consulting standpoint or holding a full-time role, it's kind of difficult to know and quantify that. Does that founding team actually know what they're talking about? And more importantly, if then do they know what they're talking about and building? Is that, do you have an unfair advantage to the other teams that are trying to build in this space? Right? That's really, really important. And I want to kind of double click on it again, right? Domain expertise isn't just about a validation of like the startup you're building. It's a validation of like, what network have you built out? Have you built out the channels and know where to turn to commercialize your product, right? Are you going to have the sales relationships? All of those things traditionally are more found in a team that has worked within that industry and that sector before they started building a business or a startup within that specific sector and theme, right? So that's why domain expertise matters. And this is very, very important when you look at like the US market and you look at the other founders that you're competing with. Because honestly, the majority of startups that are being built in today's market are not the sole original startup. There's always going to be competitors. There's always going to be other teams building in that space, some of which you might not be aware of because they might be building in stealth or they might be also at an early stage, right? So really trying to position on this point one here of like, what's unique about you and your team specific to the problem that you're solving, right? That's really what you want to convey with this slide. I don't need to know about like all of the PhDs you hold. None of the other investors need a description listing all of your years of experience, right? It's what can you tell me that's relevant to the problem that you're solving and the market that you're building this startup in? How have you been in that space, right? What are relevant logos of companies? What are relevant years of experience specific to that space? What are the relationships and the advantages that you and the team have because you've built there before? Another important piece, right? Have you been a founder before? Both, have you kind of blown up a startup and failed? And then also, have you built a successful startup and exited? Both of those actually do carry quite a bit of weight, especially in the US. So there's no need to hide failures. If you've built startups that have failed, making sure that you're also highlighting that and speaking to it, it's usually kind of a point of pride in the US that you've kind of learned that lesson on other people's money, on other investors' money, that you've come forward and you're a better founder because of it, and you're more likely to be successful because of it. The last point that I want to focus on here is the 10x advisor only. So what this essentially means is that typically you should not be featuring your advisors in your deck, right? So especially in the case of if you have like a professor from your university, if you have other founders and so on, really the advisors that deserve to be on your deck and that I'm going to care about as a VC in the US is only if they're 10 times better. Obviously, this is kind of a rough reference, but 10 times better than your existing team. What that means is someone that's like very noteworthy and well known within your industry, within your space, or a founder that's had a very, very successful exit, right? And why I say that is because it's actually more impressive that you were able to get them as an advisor than like the advising that they're doing, right? Typically, advisors are pretty far removed from startups. They might be someone that you call, once a quarter, once a month. They're not that impactful to your success and the success or failure of your startup. And we know that as VCs. So usually the only advisors we recommend putting down are ones that, like I said, are truly impressive, that you were able to have the sales skills to sell them on your vision for them to be formally put into your deck. That's really kind of what we want to see on the team slide. So once again, being succinct, being simple, focusing on what unique advantages and understanding of the market and the problem does your team bring, and only focusing on the experiences that are specific to the problem that you're trying to solve. So this is by far the simplest slide. So I'll leave it as this and kind of cover it at a very high level, the closing slide. So in terms of closing, what I mean is this is your summary slide. This is the slide that on demo day you're leaving up on your screen. In your pitch deck that you're emailing out, it's the last slide investors see. Really, what you should be doing is summarizing your strongest points, right? So say, we're growing at, I don't know, 100% month over month for the last 6 months. We have 800K in revenue year to date, and we have a team with X experience in this specific industry for this many years that's opened the door to, X, Y, and Z in our sales pipeline, right? If those are your three strongest things, that's what you're putting on that slide. you really want that last slide to be like, if I took a screenshot of it and sent it to someone else, they might not know everything about your company, but they should see, the logo and or the name, and they should see the three main takeaways. If you were to only be able to say three things in your whole pitch or in your whole deck, having that on your closing slide. It's a really powerful tool that often isn't leveraged by founders, especially in a pitch competition or a demo day setting, being able to close off your presentation doing that. You might have noticed that I'm literally doing that now on a slide by slide basis, that trying to teach you the topic, give you the three takeaways, and then on slides where it's a little bit more complex, I repeat what I said in a very short form manner, right? I'm not saying to do that slide by slide because you're not going to have time to do that. What I'm saying is that at the very end of the pitch, trying to give a quick capture of your strengths as a startup is something that often founders will just put their email and their logo, and that's it. That's the closing slide. And in the case of a demo day, that's where point two is more relevant. Obviously, this isn't relevant to if you're emailing this deck out, but like, don't waste your breath in saying like, come talk to me after, or like, come find me here, or email me here. If an investor is interested, they will email you or they will find you, right? So you calling it out is just kind of a waste of words, especially when you're limited for time in a pitch competition. So the best founders at 500 and the best founders at Andreessen Horowitz do an amazing job of closing, right? They've went through the process of, they have a very clear one-liner. They start with a very powerful emotional hook. They demonstrate their traction in three key metrics and are able to almost immediately prove their team's credibility in solving that problem. They talk about how large and scalable this problem is and how they're currently solving it today. They speak about their team and exactly why their experience is perfect for the startup they're building. And then they recap with those final three main points and kind of mic drop, right? It's a really, really powerful measure, especially when it comes to pitch competitions and demo days. And even when you're emailing this deck out, it is a kind of one area recap where you're able to emphasize to the investor kind of what you believe your strengths are. And then the last piece here, like I said, just for basics, making sure you include your contact details. Just because I was giving that as a bad example where a founder only has a logo and an email, make sure that there's still some kind of way to contact you. So those are the kind of main building blocks of a deck. So I wanted to take a moment and A, open it up for any questions again, but B, if you have a deck to share, like I said, share a link and we can take a look at some. I see there is one deck here, so we can start with that one. But yeah, before I dive into the deck, does anyone have any questions that they want to ask on any of those sections of a pitch deck? And it could be around a section I didn't include, and we can talk about why or why not. No, everyone's good. Oh yeah, same word.
I do have a question. Yes, I think we're reaching a time in the fundraising that there are only few novel ideas. Most of the time it comes to execution and the traction, because now AI is, everywhere, is taking many like stage time. I would say, this is a comment, by the way, just a comment and questions, that I think most of the time it comes to execution and traction and how domain expertise you have. Right away, if you mention that here's what we have built in a very short period of time with limited resources because I know this, and I think that gets the conversation going rather than just having novel ideas. I'm looking at the companies founded by the YC and everything, like many of them are just AI added to something, right? But the fact that they are executing quickly, going to market quickly, and I'm glad you mentioned that product market fit doesn't happen. We're doing 3.2 million ARR this year. We haven't found product market fit yet, and we still are confused with our ideal client profile. We still struggle with that, even though we're profitable, right? And I think these are great tips in terms of understanding. So I like the simplicity of this thing.
Yeah, no, 100%. And you kind of hit the nail on the head, right? It really is team and execution led. This is a little off topic from pitching and pitch decks, but I'll just briefly mention in case any of you are interested in doing some research into the topic. Sales experimentation and just experimentation as a whole, as a concept within startups, which is defining a hypothesis, picking your quantitative metric that you're measuring, and running fast-paced weekly or bi-weekly experiments to test a certain sales channel, a certain feature, a certain idea is something that we teach in the 500 Accelerator. We spend almost 6 weeks of our 12 weeks on it. YC teaches it as well, right? Being able to execute very fast, right? And not just build in whatever direction you want, but actually learn and iterate on that feedback of successful and failed experiments is something that like you can then use that with investors as showcasing your execution ability, right? Of this is what we've learned and this is what we've done. And then it isn't just benchmarked off traction. So if any of you are interested, obviously feel free to drop me a note on LinkedIn or email me, and I'm happy to share some resources. But take a Google, look into experimentation-based methodologies for building, especially tech startups or SaaS startups. It's an awesome tool. So yeah, let's take a look at the deck. And just for the sake of time as well, I'm not going to have you kind of walk us through the whole pitch, but what I'd like to do is just kind of give you my first take of if I was kind of scrolling through your deck, what immediate things I would see and kind of take away in that kind of 1 minute window. So if you guys can let me know, can everyone see my screen right now, which should be on Microsoft Teams? Okay. So let's take a look at the deck here. So immediately when I start, you're building a conversational AI for inbound calls. Okay, like I understand the one-liner. There's quite a bit of text here though, to be honest. Like you can probably like simplify some of this. It's just not needed for reading. And I assume that you're raising a $1 million seed. Obviously, I'm assuming this deck isn't the deck that you're going to market with right now, or it's the deck of an old round. But including the date, kind of not needed unless you're literally raising the round right now. But the rest of it, very, very simple in terms of, you have the name and you have the one-liner. I do think like that's enough, right? But fairly strong. This is definitely a good example of just like way too much. There's just a lot of information here. I'm probably not going to read this. If this was a deck that you were sending as a follow-up to already having a meeting with an investor, maybe you can make an exception for it. But like you can literally see, just given the fact of how much time I have right now to review this deck, there's too much in here. And this also isn't typically like a standard place that I would aim to start, right? You're starting on like 8 reasons to invest in us, and you're trying to define it from an investor standpoint. It's like I see kind of what you're trying to do, but just remember that investors kind of have a frame of reference, especially in the US, around kind of what 10 to 15 things would you expect to see in a pitch deck. And this unfortunately isn't one of them. This would be my job, right? If I'm interested, I take the meeting with you. When I'm developing the memo and going to champion the deal to our investment committee, saying, hey, this Alex, the voice AI is somewhere that I think we should invest in. Here's why. I'm going to go through the effort of putting this together in the memo. So I don't need the founder to do it. You need to captivate my interest right at the outset. And this isn't necessarily one way to do that. When I go into here, once again, like you're focusing on the technology, right? You're technology led right at the outset. So a voice AI technology designed to eliminate customer wait times. So it's not terrible. I would love to just see this written on like what goes on right now with inbound calls, as opposed to like, I don't even need to know about Alex AI or you introducing the product, like when I'm reading this title. I will say you've done like an awesome job on just like, there's not too much information on this slide, nor on the first slide. Like I said, the second one is a little bit more up for debate, but I do think really honing in on just educating me, right? Like VCs are not smart people. I'm not pretending to be smart, all-knowing across all sectors. The majority of VCs probably are not a specialist in your specific sector. You are going to know it better than the investor does. So it is your job to educate a little bit, even if they have a thesis that's aligned within that segment that, say they're working in sales tech. It would be awesome to just learn a little bit more of like, what is happening right now within kind of the inbound call automation space, right? What is it costing companies? What are these inefficiencies causing? Where is the pain? Can you quantify the pain? Right? 1 million calls simultaneously. although this is a good signal for scalability, is not educating me about the problem and the pain. So I think there's a good opportunity to immediately do that at the outset. And remember, we talked about this on the problem and the solution slide in the slides that I was just sharing with you. So now you're going into the problem, right? But you're speaking about it from a customer standpoint, at least at the outset here. So my immediately where my mind goes, and I'm just trying to share with you kind of my subjective views if I was screening through your deck, is like, is the customer paying for this? It's kind of weird that you're like focusing in on the customer when I'm assuming the customer is not the one paying. It's going to be the businesses paying, right? And then you go into like businesses are losing sales, leads, and customer insights. So once again, it's like, are you solving for enterprise? Because like, aside from sounding obvious, because if you're solving for enterprise, what I would care about, right? If it's the enterprise customer paying for this solution, it'd be like, okay, well, what do those average wait times do to my business, right? What dollars in revenue am I losing? How much money am I spending on account managers or customer support staff? Like, what is the problem for me as the buyer, as the user of this product that's going to be purchasing it? Yes, like everybody hates waiting on hold. You're like not wrong. But really honing in on like the enterprise positioning, I think is going to be really, really powerful in this case, right? And this goes back to really doing a good job educating on the problem. And I think since you have this slide here, you can see when we're reading through it sequentially, like you went into this investment analysis when I didn't know what you were doing yet. You went into introducing your product and the solution before I knew what space you were building in. And then when you introduced the problem, you introduced it from the user standpoint instead of the enterprise standpoint. So you can see like hopefully there's some similarities you're seeing between kind of my presentation and this one as to like how I kind of recommend reshuffling some of these slides. Like I said, pitching and pitch decks, it's an art more than it is a science. So there's not one right way to do it. I'm just trying to give you kind of my expertise and what we teach and preach at A16Z and 500 so that you're able to kind of take some of those best practices. And then the VCs that are going to be reading this hopefully give you a little bit more time of day and don't just, archive your email. So impact on business, right? Now you're breaking it out. I think this slide, right, finding a way to quantify these things and put it on this slide is the more important piece because now your deck is getting long, right? So now we're at the point where this is slide, what, 1, 2, 3, 4, 5. We're basically halfway through your deck and you're speaking about, what's going on in your in the business. Honestly, like, even if you didn't have this problem slide, I probably would have understood this. You would, obviously change some of the wording here. Don't call it impact on business, kind of rephrase it a little bit. But I think there's a great opportunity to just like have this as the title, right? Businesses are missing sales, they have unhappy customers and are losing market share. And then here, this is great, right? You haven't put too much information on here. The only thing that I would maybe recommend changing is try to quantify some of these things. Like what are our customers? What were they losing in revenue before they adopted our product or service? Reputation, right? Do you have some kind of quantitative metric around like your impact on NPS, right? Like on net promoter score or on customer churn, right? What percentage and how are you making a difference, right? So trying to really just simplify these slides, I think there's just like quite a bit here at the outset, just immediately to convey my problem. And like, let's see like where we are in the deck as a whole. So you have 17 slides. So this is like definitely on the long side of things. Like I said, for a teaser deck, especially in early stage, I probably wouldn't expect more than 10 slides. I've seen some Series B deals where they're raising, $35 million have less than 10 slides, right? Because the deck is just trying to get the meeting. So just don't forget that. You definitely don't need this many slides. So hopefully you're kind of seeing some of the trends at the beginning of where we could focus in on that. The solution, once again, trying to quantify things specific to the business of like, how are you impacting revenue, reputation, and churn, I think will be important. Just for the sake of time, because I don't want to spend the next half an hour just on your deck alone in case anyone else has a pitch deck they want to share. This should be combined to one slide. You definitely don't need both. How big the market is. I I don't think is terrible. You've done a decent job at qualifying it. The one thing that I would just mention is if you could speak a little bit more to like which organization is your core ICP? Like who are your strongest customers? I would love to see that on here, right? In terms of like, hey, we are relevant for a lot of different industries and sectors, but like here's the first three that we've identified, or the first one that we've identified that's really kick ass and driving our revenue. That's probably where I would focus. Business model, this looks awesome. You know, I would recommend that everybody kind of take note of this. Is like, I don't necessarily know if this is the best visual to represent it, but like in terms of the data and what's written here, it's just like super easy for these 2 points here, right? You have margin, LTV, churn, margin per customer, which I guess is kind of redundant, but these are strong metrics and very clear to show. You know, you have kind of the price per month. I don't necessarily know if you need the features listed, but like just very easy to read, right? Like I do understand very clearly that it's a subscription basis, high margin, low churn with a really good LTV. That's really all I needed to know on the traction slide. The one thing, if I really wanted to nitpick on this slide though, is that immediately when a VC sees that you're forecasting revenue, it doesn't matter. Like I literally will put zero weight into this statement every time, and founders constantly do it. You really don't need to show us revenue forecasts. What traction is what have you done to date that proves your credibility? I really don't need to know your forecast information until you get to late stage. Because in early stage, your forecasts mean, unfortunately, like as harsh as it sounds, like next to nothing. And the majority of VCs investing in early stage understand that. And yeah, maybe I'll take a pause there because, like I said, I don't want to spend the whole time just on this one deck. But the one thing that I would really, really hone in on is just trying to like simplify some of the deck, trying to shorten it, shorten some of the slides, shorten the overall length of it. You know, as we went through order by order, there was just you were doubling up on problem and doubling up on solution. And then I could see that as I scrolled down further, you doubled up on traction, right? Traction was broken out too. So um, yeah, I'm happy to answer. You know, I just kind of gave you a lot of feedback. That was like a crash course. Usually we'd spend like an hour doing that on a call with the founder. But just for the sake of time, yeah, do you have any follow-up questions? Is there anything else I can help with or anything you're like uncertain about deck-wise? And once again, I'm looking at this from the lens of like early stage US investor from pre-seed to Series A kind of thing.
Where do I pay for this?
Yeah.
Send us invoice.
Yeah, send you the invoice. Yeah. So you know, another like really good shameless plug is if you are able to work with like a really kick-ass accelerator in the US market, I really recommend it. Obviously, if you're too late stage that the terms that the accelerator is going to give you, it's not worth it. Then I'd recommend just like find who some of the mentors are in those accelerators and just like work with them or chat with them and so on. But like A16Z, 500, and YC in my opinion, do a really, really strong job on like teaching fundraising to first-time founders. If you're a repeat founder, it's going to be less of value to you. But that'll kind of be my shameless plug, I guess, for the sake of the chat. But yeah, is there anyone else that wants to share their deck? Do you guys want to drop it in the chat? If not, I'll go on to the next part of kind of my presentation that I wanted to speak about, which is like common mistakes that founders make. If you guys are interested in kind of going through that, I've listed a few, but happy to continue down that path. But I want to give someone else a chance on their deck. Obviously, it takes some guts and some pride to get roasted in front of a group of people for your pitch deck. But I promise you, like this is the only way you improve with pitch decks, and we force everyone at 500 to do this in like a group setting, so that you're not too comfortable in one-on-ones.
Simon, I don't have a pitch deck, but just what I have heard from you today, I just took some notes. So the best pitch deck would sound like this. First, it's opening, it's a hook, right? Then you have to concentrate on a problem, right? Then you have to show your traction, what you have done up to date. Then you have to show the team how is it capable to solve the problem. The solution itself, it's not the most important thing, right? And then you have to successful closing, like major points. What's your achievements, major achievements up to date? Is that correct? Did I get it
Yeah.
right?
Yeah. No, that's a great question. So the first thing that I'll say is that unfortunately there's no like perfect way to do it. It's like very specific to each given business, but like you got like 80% of it right. Like I would agree with you if you sent me a deck that had those things and it was less than 10 slides. I would agree you're covering the majority of the bases, right? A few things to keep in mind though, right? If you are later stage, like seed stage or series A, not pre-seed, and you have traction, I would probably move traction up in that mix. If you're a growth stage, right, and you already have a really strong established solution, then your solution should be a focus, right? One thing that was in the deck that I just reviewed was business model, right? If you've validated a business model with good traction, you can include that, right? Like we have this kind of CAC, like customer acquisition costs, this lifetime value, this is the margin, this is the revenue we have to date, right? Like that's totally fine to include. So there are a few nuances to it. Like I said, every deck is going to be different because like some startups have a really, really amazing team, but they're just kind of early and they don't have strong traction. So like they're probably going to put their team earlier in their deck and really speak to the team. Some startups have a team that's a little bit weaker. They haven't like they're first time founders, they don't have a lot of domain expertise, but they've built an awesome solution and already have really good traction. So that maybe they'll spend 2 slides speaking about like, look at our sales pipeline, look at all the deals we've closed in a short time frame, look at our growth rate, right? So really it is nuanced to like, where is your startup the best, right? Like, and if you're building in a very competitive space, you might need to speak about competition, right? Like, an example of that would be like if you're building an AI note taker, I would really want to see how you're different from all the other AI note takers. And if you don't cover in the deck, I'm probably just going to delete it because it's a super competitive space. So I would say you got like 80 to 90% of it right of just summarizing kind of what I covered today. But the one caveat that I want to give you is you kind of need to do a little bit of introspection into like your startup, your team, to be like, where are we the best at and or where are we the worst at? So that you can kind of understand how to structure the deck. Does that kind of answer the question?
Yep, appreciate.
Yep, awesome. Okay. Any other questions, or do you guys want to go into kind of the common problems or most common problems that we've seen? Nope, no other questions. Okay, awesome. So I will just go back to sharing my screen here. So just give me 1 second. Okay, can somebody give me a thumbs up? You guys can see the slides? Okay, perfect. So what are some red flags? And in terms of red flags, these are the 4 main things that I'd say founders fall into that I really want you to ingrain in your mind. And you can see it in the deck that we just reviewed, not on every slide, but it's literally using this as a little bit of like a checklist. So the first thing, too much information. I know that too much information is unfortunately like very subjective to the reader, right? In the deck that we reviewed on the investment rationale on slide 2, you can see it's actually not that much information if I was to count all of the words, but there's just too much. I believe there was like 8. There was like 4 across the top, 4 across the bottom. And I kind of mentioned to you that rule of 3. When you have 8 subheaders or more plus the subtext, it's a lot to take in as a reader. I want you to go through the exercise of when you create your pitch deck, try and actually sit in the shoes of the investor. A great exercise that we recommend founders do to like understand how their deck is interpreted, literally spend 60 seconds. Like set a timer, pull up the pitch deck, say on your phone, and scroll through it and see how much you can actually read in 60 seconds. And then better yet, have somebody else do it that isn't a founder or an employee of your team, right? That exercise right there, even though it sounds ridiculously easy to do, is really going to show you how much gets missed in pitch decks when there's only 45 60 seconds, maybe at best a minute 15 seconds when you're emailing it a pitch deck, right? I'm going to read your email, I'm going to read your hook, say you did a really good job with your message to me, or you got a warm introduction to me. I'm going to click on your pitch deck that's attached, or I'm going to go to your doc send link, and I'm going to give you that much time of day. So I really, really want you to hone in on that, because in the deck that we just reviewed as a group, a perfect example is slide 2. By the time I read slide 2, and then by the time I read slide 3, I probably would have already been at 30 seconds, if not more. And I highly doubt that that was the intent, right? That those are going to be the only slides that I review, right? So you really want to be mindful. It's strategic. You want to build with the investor in mind. I know a lot of people talk about and educate online around like, hey, you're building for customers. You need to speak to your customers. You need to iterate based on customer feedback. Fundraising is no different. For your materials, you should be iterating. You should be putting yourself into the shoes of the investor. You should be mindful of what questions are investors always asking you. Because if you're getting the same question a lot, it's probably because you didn't do a great job capturing and communicating that information in your pitch deck. And a lot of the time, it ends up just unfortunately being just too much information is there. So I'm not able to get through it all. The second point, this is I'd say kind of a dual-edged sword here in the sense that underselling, right? So you are too honest about your traction, about your progress, about your growth, about the strength of your team. This is notoriously done by international founders. So Canadian founders included do this when they're going into the US market. International founders like in Southeast Asia, it's fairly common in like cultural norms in like Taiwan, Korea, Japan to undersell, to be humble, right? The same can be said for some countries in Europe. Why this is detrimental is if you undersell yourself too much, both in the pitch deck, but also in your meeting with that given investor, you're going to have a really difficult time. And the reason is because of the second point. And this is US founders often make the mistake of overselling, right? So they are exaggerating their traction, they're exaggerating their expertise. But this disconnection between international founders raising in the US market and local domestic US founders overselling creates this divide, right? So once again, I'm aware that this is a subjective point. I'd recommend, trying to be as introspective as possible, trying to review and think through your own materials. But it is just a trap that I want you to be aware of. I want you to think about it, right? When you're introducing yourself and your team, are you giving yourselves the credit that you deserve, right? Are you really emphasizing what you've been able to do in a short amount of time frame, either in like the traction that you have or the team and the domain expertise that you have? It's really, really something that is common. And I wanted to include this because, especially at 500, we see and we invest in founders all around the world. We don't just invest in the US and Canada. And I've seen this divide between international founders and local ones. And I'm not saying what the US founders are doing is correct. Like, don't lie, don't oversell yourself, right? But what you don't want to fall into is looking weaker compared to the counterparts in the US that you're going to be competing with. Because, like I said, from a venture capital standpoint, I'm seeing hundreds of deals every single month, and you are competing not just against your peers, right? But you're also competing against the other deals that I'm seeing. And even if you earned my time to have that first meeting, your deck did a good job, the email did a great job, and I take that first 30-minute meeting with you, I don't want to hear, right, that you're discrediting yourself. I want you to sell me on your vision and that I have confidence in your ability to execute it. So really be mindful in the second point. And usually this is easier to avoid in the actual pitch deck because it's written, it could be from a certain perspective or tone of voice, but it's very easy to do this in an actual meeting or on stage at demo day. The third thing is something that I mentioned earlier in the presentation, is the tech and product being positioned over everything else. Some founders are putting their product like at the beginning of their pitch deck, right? I was very glad to see in the deck that we just reviewed very quickly as a group that like you saw, we didn't get to the solution and what the tech was until much later, right? That really should be the emphasis, right? Because in early stage, you are going to be pivoting so often and iterating on your solution. Your tech and product is going to change numerous times over. And by the time that you exit, you're probably not going to look at all like you did when you first took that, that check from that VC early on at your pre-seed or your seed stage. And that, once again, is totally okay and to be expected. So if the product doesn't matter that much in terms of how I'm solving things today, then what does matter, right? It's the team, it's the traction that you have, your ability to execute, it's the market and the problem and the scalability of that market that you're going after. It's the fact that I know that there's millions of customers that are willing to pay millions of dollars, right? Like that's what I'm indexing on as a VC. So I want you, when you're building your pitch deck for the first time, or you're reviewing the pitch deck that you already have, to think about like, how many slides are you spending on product? How much of that very important 60-second window that a VC is going to scan through your deck are you focusing here, as opposed to on everything else that truly does make a huge difference? The last point that I want to speak about when it comes to red flags is vague traction. So you saw that I immediately called it out when we were just doing that deck review, right? There was a revenue forecast of what revenue are we going to be at by 2029, I believe is the date that was on that deck. That is a great example of like vague traction, right? It's focusing on forecasts, or it's not specific to like, how much revenue did you make this year or last year or in the last 12 months, right? It's vague and ambiguous. Other examples of that would be like, hey, we have 10,000 users. Be like, okay, that's awesome, but like, what does 10,000 users mean? What does that mean in terms of revenue, in terms of profit? Are those paying users? Are they unpaying? Are they on a trial? Are they not? Are they churning? Are they not? Right? It's just example of vague traction. Other examples are like social media metrics, like how many followers you have or impressions, right? All of those things, they're not real. I actually wrote an article. I shared it on my LinkedIn maybe like 2 weeks ago. I would definitely recommend checking it out. It's all about like what metrics VCs use to benchmark founders that founders need to know about. But you can also just Google that topic and try and do some research of your own. It's like we're really talking about, revenue, growth percentages, whether it's month over month or quarter over quarter. We're talking about customer acquisition costs, lifetime value. What is your CAC payback period, right? Your customer acquisition cost payback. Like, how long does it take for customer to pay you in revenue the cost that it took you to acquire them through marketing and sales spend, right? Research some of those metrics, because those are the metrics, especially after you launch, right? And you have sales that a VC wants to see in your pitch deck. And we had that question asked earlier in today's lecture and workshop, which was, well, what if I don't have that data? I don't have that sales information. That's fine. Like, it's to be expected. Not everyone's going to have every piece of, awesome revenue growth rates, CAC, and so on, especially at pre-seed. But it's then, what is your traction, even if you're pre-revenue, right? Do you have a wait list? Do you have a sales pipeline? Do you have any letters of intent that are signed? Do you have any pilots that you ran, even if they were unpaid? I would love to see the pilot information. It was like, hey, we ran a pilot with XYZ company, and we reduced their, let's use the example of the pitch deck that we just reviewed. We reduced the customer wait time by 25% during this pilot that we ran for 3 months. Like, putting in that information, that is clear black and white traction, instead of the founder that's going to put in like, hey, we're on pace to do this much revenue in the next 5 years, and we have this many like social media followers, and this is our huge sales pipeline is a potential of $20 million in revenue. Like, it means nothing. It's just vague. It's forecasting. Like I said, traction, and the sole point of it is to establish credibility and trust, right? That I know as an investor and believe in your team's ability to execute upon this vision in particular, right? So it's very, very important to avoid this red flag, right? To try and be as clear as possible when it comes to what have you built to date. And founders often try to, beat around the bush, right? Not be very transparent. As an investor, I'm going to keep asking questions, because if we move forward with an investment, I'm going to need to create what's called an investment memo and go to my investment committee, that is the other partners in the fund, and I'm going to have to basically pitch your business to them. And if I'm interested in it, I need to know how far along you are in solving it. And you just need to be, upfront and forthcoming. There's no point trying to mask your traction not being super strong, or certain pilots not being clear if they were paid or not paid. because I'm going to need to find that information out anyways if we want to move forward. And if it's not a fit and you got rejected, that's okay. Like rejection is totally a name of the game, and you can come back and try again with more traction later down the path if that was the main holdup for the deal, right? So I really wanted to introduce you to these 4 things. And like I said, these are data driven in the sense that we have seen these problems through 500 over the last 3 years. There's something that we've been documenting as a team of being the common mistakes in the pitch decks that we receive for both founders that we do invest in and founders that we don't invest in as well. So hopefully you found it helpful. I know we're kind of at the last 10-ish minutes here. Appreciate everyone's attention because it's a lot of me talking. But yeah, if anyone has any other questions, a deck that they want me to quickly flip through, give any feedback on, I'm like absolutely happy to do that. But other than that, I just really appreciate everyone's attention and coming in and attendance and everything as a whole. Obviously feel free to reach out to me. That's an absolute no-brainer on LinkedIn, or I can drop my email here in the chat, and happy to kind of have any side conversations and things like that with you guys. But yeah, want to open the floor to everyone because we covered a lot of information here today. Like I said, typically we do this over multiple sessions within 500 with deck reviews and everything. So yeah, does anyone have anything?
Simon, it was effective. Thank you.
Oh, awesome. Yeah, no, great to hear. Does anyone have a takeaway that they want to share? Is there something that stood out in the last, hour and 20 minutes that kind of is a mistake that you've made or something that you're going to go take and implement in your pitch deck?
Less about the product, more about the problem.
Okay, awesome. Yeah, no, that's a great takeaway. Does anyone have another one to share? Yep.
I can share
Simon?
one. What I liked is the closing slide. Should be the summary that can be snapshot or like snapped instantly and be shared. So I really like that because your closing slide will stay on the screen until the next presenter comes in or something, and that could be the summary of your entire pitch deck. And I never thought of this that way, so this is very good.
Okay, awesome. Yeah, no, that's great to hear. Yeah, implementing a closing slide, definitely something that's just unique, right? It's just a different way to stand out. Anyone else?
Yeah, Simon, me again. It was very useful to hear that you shouldn't concentrate on your projection, because that's the mistake we are doing. We're concentrating on a projection, which is actually, you said it means nothing. It's true.
Yeah. So I'll give a little bit more context to that because I do think it's something that's pretty important to figure out. Like at early stage, there is next to no diligence when you look at like projections, right? Like you think you put together a data room, you have these like fancy financial models. Usually we don't look at it, right? We'll look at the unit economics of like how much are you profiting, if anything, from your existing users or your customers. But like, how can I expect you to even know where your sales are going to be at in like 3 or 4 years when your product might change, your pricing might change, right? So it's actually a common pitfall that founders try and like really dial in, and they think their projections showcase scalability. That's not the case. Your market and the problem that you're chasing is how you showcase scalability, right? And being able to solve a sliver of that market, of that problem. So yeah, that's an awesome takeaway. I'm glad you kind of walked away with that because it's a really easy place to fall into, having a big fancy financial slide where you have this like hockey stick curve graph and you have your bar chart and all of that stuff. It's not needed at an early stage because you haven't proven anything in terms of like consistency, reliability of that revenue to be able to deliver on those projections. Once you cross like basically Series A and onward, complete opposite. I definitely do expect you to have projections, and you should be hitting them. And you're going to be held to your accountability of hitting them with your investors. But at an early stage, you're lucky that you don't really have to focus in on that too much yet. Okay. Any last questions? No? Everyone's good?
Simon, may I add one more thing quickly? I learned this from Malcolm Lewis, who's a pitch deck coach. I work closely with him. He's a mentor of mine. He says that your pitch deck should be like phone screen friendly. Like many VCs will quickly see it on the phone, right? And it needs to sort of pass the phone test. That's also very important.
Yeah. So passing your phone test is a great way to think about. Like I kind of framed it today as a VC is giving you kind of 60 seconds of attention, right? And they're most likely scrolling through this quickly on their computer or on their phone. One other thing to keep in mind that I've actually seen some founders do it, probably first time I saw it was maybe a year and a half, 2 years ago. Some founders have two variants of their pitch deck, right? So they have their like traditional kind of whatever you want to call it, like the desktop aspect ratio 16:9. And then there's other founders that literally will create their deck in the aspect ratio of just like, an iPhone screen, basically,
Yeah.
right? So that portrait landscape orientation, that like each slide is maximizing the space on a phone. I've seen some founders do that in the Bay Area. Mind you, like, yes, it's nice, it's convenient, it works well, it saves me needing to zoom in, but like if you do a shit job on your traction and on your team and so on, it's not going to save you like an awesome design deck and so on. So don't get me wrong on that part, but yeah, it's another thing that you can try experimenting with, right? When you're running this experiment and you're sending your pitch out to investors, try a portrait orientation deck, see if it makes any difference in response rates, open rates, and so on. If it doesn't, well, then you can stick with the normal version. But if it does, it might be worth kind of doubling down and staying within that path. But yeah, no, that's a great point around kind of passing the phone test, because founders often think that VCs sit down with their pitch deck, print it out, or like spend 10 minutes reading through it. It's definitely not the case. If I was getting the 300 pitch decks a month, I can only imagine how much time it would take me if I was spending 10 to 15 minutes reading through every single deck to an extent. Usually it's like read through the first 3 slides and delete it, or finish the deck and they still only get 60 seconds.
Just it was my takeaway that they had only 60 seconds, and usually they use it by opening in the phone just to scrolling. It's why I'm thinking that, yeah, it's important to prepare the deck in the way that it would be easy to read on the phone.
Yeah, 100%. And Rokas, one other thing to keep in mind is sometimes, right, you can have a very succinct deck. And if you're at like a seed stage or a series A where there's a lot more information to share, after you have that investor meeting, so they've got your first deck, your first email, they scrolled through it, they liked it, they booked a meeting in with you, you had the meeting, and then they're like, hey, do you have a little bit of a longer deck that you'd be able to share with me that maybe goes a little bit more into like the competitive landscape and your traction? It would really help me in preparing my investment memo and bringing it to the rest of the team. That then is a place where you can share kind of the longer deck that then they will sit down. And when I'm building an investment memo for some of the deals that I'm championing, I'm spending more time obviously on the materials on the deck to prepare the memo. So there's some flexibility later in the process, but early stage, yeah, you're spot on, right? Like early in the process, you want it to be as succinct and as short as possible. Awesome, everyone.
I was going to add similarly that a lot of companies in Lithuania, are not really like early stage companies if you're looking just from like a Lithuanian perspective or European. But when they come to the US and pitch the US investors, their numbers sort of fit with the cohort of early stage companies. And so they're looked at as early stage companies. So it's just something to like wrap your mind around when you're a Lithuanian founder, you're pitching in the US. I think the point you made about, don't pitch what you want to say, think about what they need to hear, and really thinking from that perspective of like, I can tailor what I can say about my product or my team or et cetera, but I need to think like, what do I want them to take away? That was really good. Thank you.
Awesome, Carlos. And that actually triggers a good point that in case it's useful for all of you, today in the US, when you're looking at stages and so on, your average pre-seed with next to no traction is doing $8 million US valuation. Seed stage is 15 to 18 million, and Series A is beyond that, like 25 to 40, if not more, right? Those benchmarks, that's what we're cutting terms on right now. That's what we're investing on right now through 500 and E16Z. So it gives you a good frame of reference on like, if you're in the Lithuanian market and you've raised at like a $5 million valuation, you're doing like $1 million or $2 million in ARR. When you come to the US, it is a different game of like valuations, the numbers, where you're going to kind of get slotted amongst this like pre-seed to Series B trajectory. So do some research into those metrics, but once again, do remember that you're going to be judged off US traction as well. So it is kind of that hybrid approach and consideration. But Anyways, everyone, I know we're at time, so I just wanted to quickly call out. Yeah, I did drop just my personal email, my LinkedIn in the Teams chat. It was absolutely amazing speaking with all of you today and meeting you all. And yeah, thanks again for your attention for the last hour and a half, and hopefully you got some good takeaways.
Yeah.
Thanks.
Thank
Stay
you so
warm, by the way,
Thank you.
for those that didn't know, Simona's dialed in from Saskatchewan, Canada, where it's negative 28 Celsius today. So
Yeah.
it was fun here out.
Ačiū, Simonai.
Thanks.
Thank
Bye.
you.
Thanks, everyone.
Thank you all for participating.
Thank you.
Thank you.